You think successful investing begins with choosing the right security? Think again. Before you earn a single dollar, an invisible network of brokers, exchanges, algorithms, benchmarks, fees, and rules is already shaping the outcome. A brilliant investment idea can be destroyed by one poorly executed trade. A skilled portfolio manager can look unsuccessful simply because of the wrong benchmark. And hidden market frictions can quietly consume the return you thought you earned. Today, we pull back the curtain on how financial markets and investment management really work. We are going to study market structure, benchmarks, and the investment management industry. This topic is important because investing is not only about choosing securities, it is also about understanding the system that connects investors, issuers, advisors, brokers, exchanges, funds, custodians, regulators, and data providers. Think of financial markets as a large network. On one side, there are owners of capital, households, pension funds, insurance companies, endowments, foundations, corporations, and governments. On the other side, there are users of capital, companies, governments, and other issuers that need financing. Investment management sits between these groups. The system has two broad functions. First, capital formation. This is how issuers raise money to fund operations, investment projects, acquisitions, public programs, or refinancing needs. Second, capital allocation. This is how investors decide where capital should go based on expected return, risk, liquidity, fees, taxes, and constraints. A key lesson is this: markets are not just places where prices appear. Markets are systems with rules, incentives, frictions, and institutions. A good portfolio manager must understand not only what to buy, but also how markets work, how trades happen, how costs enter performance, and how benchmarks shape evaluation. So today, we will build the full picture step by step. Let's begin with the distinction between primary and secondary markets. A primary market is where newly issued securities are sold to investors, and the issuer receives the proceeds. A secondary market is where existing securities are bought and sold among investors. This distinction matters because the economic function is different. In the primary market, the main purpose is capital formation. A company may issue shares. A government may issue bonds. The issuer receives capital that can be used for investment, operations, or refinancing. In the secondary market, the main purpose is liquidity, price discovery, and risk transfer. Investors trade with one another. The selling investor receives the cash, not the original issuer. At first, it may seem that the secondary market is less important to issuers because it doesn't usually provide new cash directly to them, but that would be too narrow. The secondary market can strongly affect the issuer's future cost of capital. When investors know that a security can be traded easily, they may be more willing to hold it. When trading is difficult, uncertain, or expensive, investors may demand compensation for that lack of liquidity. Secondary market prices also provide signals. They reflect expectations about cash flows, risk, financing conditions, and investor confidence. So primary and secondary markets are connected. A strong secondary market can support future primary issuance. Weak secondary market liquidity can make new financing more expensive. The lesson is simple. The market where securities trade later can influence the terms on which securities are issued today. Now let's look at trading venues and market participants. A security can trade in different types of venues. The venue affects how buyers and sellers meet, how orders are prioritized, what information is visible, and how prices are formed. Exchanges are organized markets where securities trade under exchange rules. Modern exchanges rely heavily on electronic order books, matching engines, market data, and surveillance systems. Broker-dealers can play more than one role. When acting as a broker, the firm helps a customer execute a trade, usually as an agent. When acting as a dealer, the firm trades as principal, buying from or selling to customers using its own inventory. This difference matters because the economic relationship changes. A broker helps arrange execution. A dealer provides liquidity directly, but also manages its own inventory and trading risk. Market makers stand ready to buy or sell at quoted prices. They provide immediacy. That means investors do not always have to wait for a natural counterparty to appear. Electronic communication networks and alternative trading systems use electronic methods to match buyers and sellers. Some display orders openly, while others provide less pre-trade transparency. Over-the-counter markets operate outside a centralized exchange order book. Many bonds, derivatives, structured products, and less liquid securities trade this way. The important idea is that trading is not identical across all markets. The structure of the venue affects transparency, liquidity, cost, speed, and execution quality. A portfolio manager should always ask, where is this trade happening? Who is taking the other side? And what frictions are involved? Let's continue with trading mechanics. A trade begins with an investment decision, but it does not end there. The trade moves through a chain of processes: order creation, routing, execution, confirmation, clearing, settlement, custody, and reporting. Order creation begins when the investor or portfolio manager decides what to buy or sell, how much to trade, and how urgent the trade is. Order routing is the process of deciding where the order should go. A broker may route the order to an exchange, another trading venue, a market maker, or another source of liquidity. Execution occurs when the order is matched with liquidity. Execution quality depends on price, speed, likelihood of execution, market impact, price improvement, fees, and delay risk. After execution, clearing and settlement make sure that securities and cash are delivered properly. This is where operational discipline becomes essential. A trade is not fully complete simply because a price was agreed upon. Custody and record keeping then protect ownership records, safekeeping, reconciliation, valuation, corporate actions, and reporting. For individual investors, these steps may feel invisible. For institutions, they are central to operational integrity. Electronic trading has reduced many manual frictions, but it has not removed market frictions. It has changed them. Speed, routing logic, order type, queue position, hidden liquidity, market fragmentation, data quality, and adverse selection all matter. The better question is not simply, can the order be executed? The better question is, can the order be executed in a way that fits the investment objective, risk tolerance, liquidity need, and cost budget? Now, let's discuss common order types. A market order seeks immediate execution at the best available price. Its strength is execution certainty. Its weakness is price uncertainty, especially in fast-moving or thinly traded markets. A limit order gives price control. A buyer specifies the maximum price they are willing to pay, or a seller specifies the minimum price they are willing to accept. The trade-off is that the order may not execute. A stop order becomes active when a trigger price is reached. Investors may use it to manage downside risk or to enter after a price move, but the final execution price can differ from the trigger. A stop limit order becomes a limit order after the stop is triggered. This adds price control, but it also increases the chance that the order may not execute. An algorithmic order uses rules to divide or schedule trading across time or venues. This can help reduce market impact, but it depends on assumptions about liquidity, volume, and market conditions. There is no universally best order type. The correct order type depends on the investor's objective. If urgency is high, execution certainty may dominate. If price control is more important, a limit order may be preferable. If the order is large, the manager may care more about market impact and information leakage than immediate speed. So, order choice is not a mechanical detail. It is part of investment implementation. A well-designed investment decision can lose value if the trade is executed poorly. Next, let's examine liquidity and trading costs. Liquidity is the ability to trade a meaningful quantity quickly at a price close to fair value with limited market impact. Liquidity has several dimensions. Tightness refers to the size of the bid-ask spread. Depth refers to how much can trade near the current price. Resiliency refers to how quickly liquidity comes back after trades. Breadth refers to the number of active venues, participants, and counterparties. Immediacy refers to how quickly an investor can trade without waiting. The most visible trading cost is often the commission or explicit fee, but many important costs are implicit. Bid-ask spreads matter because buyers and sellers typically face different transaction prices. Market impact matters because large orders can move prices. Delay cost matters because prices may change while the investor waits. Opportunity cost matters when desired trades cannot be completed. Implementation shortfall is a broad way of thinking about the gap between the return implied by the original investment decision and the return actually achieved after trading. For portfolio managers, trading cost is not a back office issue. It is part of the investment process. A strategy may look attractive before costs, but become unattractive after turnover, bid-ask spreads, market impact, financing costs, taxes, and management fees. This is especially important for active strategies. If the expected advantage is small and trading costs are high, the investor may not receive the benefit. The lesson is clear. Performance must be evaluated after implementation costs, not only before them. Now we move to market indexes and benchmarks. A market index measures the performance of a basket of securities designed to represent a market, market segment, sector, style, country, maturity range, or other exposure. A benchmark is a standard used to evaluate performance, risk, style, and mandate compliance. An index may be used as a benchmark, but a benchmark is more than a number on a report. It is the reference portfolio against which decisions are judged. A good benchmark should be appropriate. It should reflect the manager's true investment universe and mandate. It should be investable, meaning that a realistic strategy can obtain exposure to it. It should be transparent, with understandable constituents, weights, and rebalancing rules. It should be measurable, so returns and risks can be calculated consistently. It should be specified in advance, not chosen later to make performance look better. And it should be owned by the decision process. The benchmark should align with the investor's policy, objective, and constraints. Benchmark selection is a managerial decision. A portfolio may look risky or successful depending on the benchmark used. A reasonable manager can appear unreasonable if judged against the wrong reference portfolio. Indexes also embed choices. They are not pure facts about the world. Index providers make decisions about eligibility, weighting, rebalancing, corporate actions, free float, liquidity screens, country classification, sector classification, and dividend treatment. So when you see benchmark relative performance, always ask, is this the right benchmark for the investment problem? Let's now discuss index construction and benchmark relative performance. Indexes can be built in different ways. A price-weighted index gives greater weight to securities with higher prices. It is simple, but price alone may not represent economic size. A market cap-weighted index gives greater weight to larger companies by market value. This often represents the aggregate value of the included market. A float-adjusted market cap-weighted index focuses on shares available to public investors, rather than all shares outstanding. This can make the index more investable. An equal-weighted index gives each security the same weight at rebalance dates. This increases the relative importance of smaller constituents and usually requires more rebalancing. Fundamental or factor-weighted indexes use rules based on accounting measures, style characteristics, risk factors, or other signals. These may intentionally tilt toward exposures such as value, quality, size, momentum, or low volatility. Once a benchmark is selected, performance can be evaluated relative to it. Active return tells us whether the portfolio outperformed or underperformed the benchmark over the period. But active return alone is incomplete. We also need to know how much benchmark relative risk the manager took. Tracking error measures how much the portfolio's returns differ from the benchmark over time. Low tracking error means the portfolio stays close to the benchmark. High tracking error means the manager is taking larger active positions. The information ratio relates active return to active risk. But no performance measure is perfect. Short samples, changing exposures, illiquid holdings, stale prices, leverage, costs, taxes, and benchmark mismatch can distort interpretation. Always separate benchmark relative success from the investor's absolute objective. Now, let's turn to investment vehicles and asset owners. Mutual funds and exchange-traded funds are pooled investment vehicles. A mutual fund pools money from many investors and invests in a portfolio managed according to a stated strategy. Investors generally buy or redeem shares through the fund or an intermediary at net asset value. An exchange-traded fund also provides pooled exposure, but ETF shares trade on an exchange during the trading day. Investors usually buy and sell ETF shares at market prices. This creates important differences. For mutual funds, investors focus on net asset value, fees, distributions, redemption rules, and manager process. For ETF, investors also focus on bid-ask spreads, market liquidity, premiums or discounts, tracking quality, and the creation and redemption mechanism. A key point: the vehicle structure is not the same as the investment strategy. A fund can be active or passive. An ETF can be active or passive. A mutual fund can be active or passive. Beyond funds, the investment management industry includes many asset owners and advisory relationships. Pension funds invest to meet retirement obligations or support participant accounts. Endowments and foundations invest to support institutions and missions over time. Hedge funds are private investment vehicles that may use flexible strategies, including leverage, derivatives, short selling, and less liquid positions. Investment advisors provide advice, planning, portfolio management, or related services for compensation. Brokerage accounts allow investors to buy and sell securities, but a brokerage relationship and an advisory relationship may involve different services, duties, compensation structures, and conflicts. Understanding the vehicle and relationship is essential before evaluating performance. Finally, let's bring everything together with active and passive management, industry structure, costs, and market integrity. Passive management seeks to track a benchmark or systematic exposure. It usually involves less active discretion, but it does not mean there is no risk. Passive investors accept benchmark risk, tracking differences, rebalancing costs, tax considerations, and possible concentration in the benchmark. Active management seeks to outperform a benchmark, manage risk differently, or achieve a specific objective through decisions such as security selection, sector allocation, credit selection, factor exposure, tactical allocation, liquidity management, or hedging. The active-passive decision is not only about market efficiency, it is also about objectives, evidence, costs, taxes, governance, capacity, constraints, and manager selection. Active management may make sense when a manager has a repeatable edge, when the market segment is less efficiently priced, when the investor has objectives that differ from a standard benchmark, and when expected benefits remain after fees and trading costs. But active management becomes less attractive when costs are high, markets are highly competitive, tax efficiency is poor, monitoring is difficult, or the evidence of skill is weak. The investment industry is a chain of delegated decisions. Asset owners, boards, consultants, advisors, asset managers, fund sponsors, brokers, custodians, data providers, index providers, and regulators all play roles. This creates agency problems and conflicts of interest. That is why governance, disclosure, contracts, fiduciary discipline, compliance, monitoring, and regulation matter. Costs also matter. Fees, fund expenses, trading costs, advisory fees, platform fees, performance fees, and opportunity costs all reduce investor outcomes. Market integrity supports fair, orderly, and efficient markets, but it cannot guarantee good investment results. So the big lesson is this: an investment idea is only the beginning. The final outcome depends on the benchmark, vehicle, trading process, cost structure, governance system, and market rules around it. Thank you for joining me today. I hope this lecture helped you see how market structure and investment management fit together.